Hi, everyone, and welcome back. And this is Module 6, where we're looking at external sustainability reporting, but more specifically, the assurance of the external sustainability reporting. So let's get into this because there's a few interesting points we want to highlight, especially for career opportunities, especially if you want to be a CPA in the future. Yes. Okay. So what is external assurance? External assurance is when an independent practitioner expresses a conclusion about the outcome of an evaluation or measurement of the subject matter against the criteria to enhance the degree of confidence of the intended use other than the responsible party. The responsible party in this case is the reporting company that has delivered the sustainability report. So you get a third party in, and then they do a double check, do all the initiatives and things that they have got in the sustainability report, do they add up? Is there sort of evidence there that they are doing what they say they're doing? Okay. So this will be a short module, but we'll get into some of the key issues that you need to know. All right. So we know the current trend in the world, like even since 2001, there has been a major increase in the practice of sustainability reporting. So a lot of this has been voluntarily, whereas 2012, over 46% of reports listed on GRI's Sustainability Disclosure Database indicated some form of external assurance. Now, you know, from week 1 and week 2, we're talking about voluntary rates of sustainability reporting are near 80%. When it comes to assurance, we're not saying there are rates of 80% of assurance. It may be only half that. We'll look into that, but don't expect assurance rates to be as high as a voluntary sustainability reporting rates, because it costs money to get your reports to be assured. And so by 2013, the G250 assurance levels was 59%, and compared to 46% in 2011. Now, that's an old survey, and even these days, the assurance levels are not much higher than 59%. Let's have a look. So let's just have a look at the 3 levels of assurance in sustainability reporting. Well, not 3 levels of assurance, but 3 general measures of status where reporting companies are. Now, what we talked about in week 1 and week 2 was the general voluntary rates of reporting, and they're up around 80%, as you can see over here, right? 80%, yes. All right. And that's from the slide in week 2. Whereas if we look at the assurance rate, they're around about, here we go, 50%. There you go. You see my finger pointing to it, 50%. Yes. And somewhere in week 3 and week 4, we actually talked about integrated reporting. And where are we there? Well, that's only around 30%. All right. So you've got the 30, you've got the 50, and then you've got the 80%. Think of them as kind of where the trends are these days, especially in the developed world. When we look at the Asian markets, European markets, and Northern American markets. Now in Australia, external assurance is voluntary, but despite this, many Australian companies seek assurance. Up to 54% of Australian companies seeking external assurance back in 2013. Like, it's not much more these days if we look at the most recent KPMG survey. Nearly 60% of Australian companies sought external assurance in 2017 compared to 54% in 2013. So the percentages are going up there, but by a small amount. But at least the great news is that the trend is in the right direction. So if you want to get a job in assurance, you know that your future is bright. Yes. Wow. All right. So what else can we learn? Well, further, even in China, the China G250 companies are reporting increasing levels of assurance. It's going in the right direction. So there's the global assurance rate we have above me. But even in China, like, has gone up 15% since 2020. From 2020 to 2022, the assurance rates have gone up by 15%. Now, you can imagine the reason for that. Like, during that time, COVID had closed the borders. It's very hard for external stakeholders, especially for foreign investments of companies in China through the Shanghai Stock Exchange, through the Hong Kong Stock Exchange, to actually get sort of visibility of what's going on in China. And so it makes sense that Chinese companies would go and get a third party to get insurance, to increase transparency, to look after the stakeholders. Why? You'll see in a minute, because there's academic evidence that when you get assurance, your stock price can go up. When you get insurance, the loan rates or the cost of borrowing can go down. These are all motivations for why companies are not only voluntarily reporting, but are increasingly getting their sustainability reports assured by a third party. Wow, this is so exciting. All right, so let's have a look at what that means. Why assure? Well, you're going to pay top dollar. Now, let me note here that 70% of the companies that are doing the assurance, let me listen to this, are the CPA accounting big four. So you're talking PwC, KPMG, you've got Deloitte's, and what was that other one? Well, in Malaysia, it was BDO. It's a big five in other parts of Asia, the big four in Malaysia. And then you've got Ernst & Young. That was the other one, right? So you've got Ernst & Young, PwC, Deloitte, KPMG, got BDO, and you've got others that are chasing on their coattails. But the big point is that they make up 70% of the assurance by service providers. Therefore, if you want to get a job in a CPA firm, in an assurance, you know your future is going to be bright, because the demand, the trend line is going in the right direction. The trend is going up, is not going down. And that's where you want to be in your future workplace opportunities. So why assure? You pay all this money and increase recognition, reduce data quality risk, increasing number of standards and guidelines, strengthened robust internal reporting and management systems, improve board CEO level engagement, improve stakeholder communication, and increase pressures for stakeholders. Now, it's always great for educators, like teachers like me, to just throw lists at you, go and memorize them, and then we'll examine you on that. If you memorize them all, we give you a high grade. No, we want to go one step further. Think about these 7. Which of these 7 are going to inspire trust in the stakeholders of the reporting company? It's likely going to be the first one. It's likely going to be number 6, increasing transparency, and number 7. All right, so where the stakeholders, like financial service providers, you're talking about shareholders, they just want increasing confidence that what you are reporting is true in fair view. Now, this is not going to be a true and fair view as per GAAP reporting standards in the US or IFRS in Australia and Europe, but it's going to be a more moderate level of assurance. And so that's to inspire trust and transparency of the company's activities behind what they're reporting. However, if we look at 2, 3, 4, and 5, notice these are roles in which the third-party provider can help the company learn to become a better reporting entity, which in the long term will inspire better trust and transparency for the stakeholders in the future anyway. Like, learning helps you become a better person, helps you become a better organization, so you can do better sustainability activities in the future and better reporting in the future inspire better transparency and trust in the future. So in some ways we could put an arrow between learning that inspires better future trust in the future. So if we pay top dollar over here, then we're going to get payback in terms of improved ways in which we can better report and better operate and inspiring better trust with our stakeholders. So that's why we insure, and that's a good thing. Let's have a look at the phases of insurance. There's a planning engagement phase. There's an execution phase. And if I get out of the way over here, yes, you can see above me, it's the reporting completion phase, but I don't want to get out of the way. I want to be in your face and delivering good value in what this subject matter talks about. Under the planning and engagement, it's all about the client acceptance, understanding engagement, determining the subject matter and materiality. And notice that one thing you'll learn with assurance is if you are the client, you're paying money to the Big Four accounting firm, you can tell KPMG, you can tell EY, you can tell Deloitte, you can tell the accounting firm, we want you to give us assurance in areas of A, B, and C, but we don't want you to look at D, E, and F. Can you do that? Sure you can. Can you do that with financial reporting? No. With financial reporting, auditors are bound to actually give a true and fair view of the totality of the financial reports. But when it comes to assuring your sustainability report, the reporting entity can decide the areas they want assurance on. So there's a little bit more leeway or gray area about what is being insured, what is not being assured, I mean. So then there's the execution phase, general principles, strategic disclosures, and the using the work of experts. And finally, reporting completion, representations, subsequent events. Wow. All right, so let's just go into a little bit more detail here. So the required considerations at the time of project planning are basically laying out what are the responsibilities of the assurance provider, what is the access you're going to give, the expected form and the content. So this is where the reporting entity is telling the assurance provider, we want you to cover A, B, and C, but not D, E, F, and G. Wow. And then the timeline, resources involved. And so because you're paying money to the assurance provider, you get to dictate the extensiveness of this assurance report. Summarizing, we're talking about the scope of the insurance. There's the responsibility of management and the insurance provider, and access and evidence to be provided. And basically, yes, the reporting entity, yes, they can dictate the scope and the depth of the assurance report. However, the details of the scope and the depth still have to be reported anyway. So you as a stakeholder can decide whether that third-party assurance report is broad and deep or it's narrow and shallow, because the reporting entity still has to say what is the scope and the depth of the assurance report. None of that happens when it comes to the auditor's report on the true and fair view of the profit and loss, the balance sheet, and the cash flow statements. Wow. So there's the assurance report statement that will have to be made. And then there's going to be a separate management letter. Okay. As I said earlier, 70% of the sustainability assurance reports are by accounting firms. That's a good thing if your employment future is focused on working with these accounting firms. Let's have a look at what the GRI statement says about the assurance engagement. it says the following, that basically the description, the reporting organization has to give a description of the policy and the current practice with regard to seeking the external assurance for the report. And number two, if the report, that's a sustainability report, has been externally assured, then they must do three things. That is, they have to give reference to the external assurance report, like statements, opinions, and if not included in the assurance report, accompany a description of what has and has not been assured and on what basis. So basically, what is the breadth and what is the depth of the assurance of the sustainability report? And then the relationship between the organization and the assurance provider, for example, the Big Four accounting firm. And finally, whether and how the highest governance body or the senior executives, when we talk about the C-suite, right? What is their involvement in seeking external assurance for the organization's sustainability report? Was their involvement really overarching and monitoring and telling their third-party assurance provider, don't touch that, don't look here, don't look there? Or were they hands-off and actually gave carte blanche to the third-party assurance provider? In other words, they allowed the third-party assurance provider to look anywhere they like, all right? Or is there something in between? So just keep this in mind. The GRI reporting standards, the 100 series standards, really lays out what needs to be listed in terms of the terms of the agreement with the third-party assurance provider when they come and do an assurance report on their sustainability report. Wow. So, this is like the terms and conditions of the contract with the third-party assurance provider. Why? Because it's a gray area. If you look at the GAAP standards, the IFRS standards, when it comes to the audit statements and the auditing of the profit and loss balance sheet and the cash flow statement, there is very little gray area about the scope of the auditor. In other words, the company cannot tell the auditor what to and what not to do. But when it comes to the sustainability report, the company can do that. And then because of that, GRI says, all right, we want to have these details here so that you, the reader of this report or the stakeholder, can make a judgment about whether the assurance provider had carte blanche. That means they could do whatever they like, or were they really restricted in setting up and giving a third-party opinion on assurance of the sustainability report. Now, we're getting near the end of what we're doing in this module, but just we get back to the standards. I've mentioned the GRI that has their standards, but then there's the International Standard on Assurance Engagement issued by the International Federation of Accountants. There's the Accountability 1000 Assurance Standard, and then there's the ASAE Assurance Engagements, other than audits or reviews of historical financial information issued by the Australian Auditing and Assurance Standards Board. So there are bodies out there, and yes, sadly, there's just too many of them and not just one. That's the way it is with a lot of things in this world. You have these competing bodies, and then over time, they will amalgamate and consolidate and become one. And then in 5 years' time, we have much more clarity about what we can expect and not expect. But for now, there are different bodies out there. The GRI is the dominant one, and that's the one we really need to pay most attention to. So there's some more information. The IASE 3000 is more specific and is used heavily by accounting and the audit professions, which guides how third-party assurance on sustainability reporting needs to be undertaken. Getting near the end, what are some of the academic findings? If we do pay for a third party to come and give assurance as to the validity, the reliability of our sustainability report, well, academics have looked at the data and found that when you get third-party assurance providers, the share price can go up, the cost of capital can go down. However, the actual name of the third-party provider may not matter as much compared to whether they are professionally certified to do the assurance or not. So it may not matter if it's a Big Four or a non-Big Four, as long as they are certified, they have the engineering certifications or the CPA certifications to do the assurance of the sustainability report. Wow. All right. So are there any major differences between financial statements audits and sustainability assurance? I've given you a hint that the latter is much more of a gray area. Why? Because the reporting party can get involved and limit or not limit the scope of the audit assurance engagement. But with financial statements, they cannot get involved. That's the biggest difference you need to know. But what are the other areas apart from true and fair view and materiality? Well, the other areas, and you can put this into a table like you see above. There are 5 areas, that is the subject matter information, the relevant framework, the criteria, the audit assurance standard, and the level of assurance provided to users. And so each of those 5 areas you could put into the table as I've got above, and you can say, for example, the subject matter information, the whole report versus a selective part of the report. So therefore you can put the subject matter information here, the whole report, and it's a selective part of the report here. For the relevant framework, under the financial statement audit, it is required by law or standard versus just some GRI regulation or as preferred by the client. But then GRI requires that those preferences need to be disclosed. With the criteria, it's the accounting standards versus the sustainability reporting framework like GRI. With the audit assurance standard, you get the ASAs, the audit assurance standards, the audit accounting standards here. But here for the sustainability assurance audit, it is the IASC or the Audit Accountability 1000 audit standards. And then you got the level of assurance provided to users. Here, it's the reasonable, true and fair, but here we're talking of, as set by the IFRS or GAAP, but here it's as agreed to by the reporting entity. And of course, as I said, you have to disclose this agreement as per the GRI standards. So there you have it. We've gone on a whirlwind trip from week 2 to say, oh, it's all lovey-dovey because there's 80% disclosure of sustainability reporting. But 80% of companies are disclosing through sustainability reports. However, only 50%, that is only half of the M100s, are going out and paying top dollar for getting the audit companies or engineering companies that are certified to come and assure the sustainability report. Much less companies are actually integrating, they are combining the sustainability report with their profit and loss and balance sheet report all into one report. So just think in terms of those general benchmarks, 30%, 50%, and 80%. And as we go through from week to week, we can just understand that, yes, it's really nice to pay money for the assurance audit firm to come and give assurance for our voluntary disclosure. But just remember, you are paying money not just for the trust it provides to stakeholders because they have visibility, because they have transparency of the sustainability report. Also, those third-party providers, they can give you feedback so you can learn more, so you do a better sustainability report, you improve your operations in the coming 12 months, in the coming 3 years, and you get to do better sustainability reports in the future. Therefore, that will actually feed back and actually provide greater trust for the stakeholders of your company. And so it's a circle that goes between you learning to become better at your sustainable operations and reporting, and then that feeds back into trust. You get that assurance, and then that provides greater transparency and openness to your stakeholders. Your share price goes up, your cost of capital goes down, and everything gets paid back over time, and we're on an uptrend of bigger, better, faster, and more competitive. And that's the type of trend that we want to see this whole reporting and assurance and operations to get into. In the coming weeks, we will look into more detail into operations. But for now, we're starting to see that this reporting and assurance, it's not just rhetoric. It can mean a great value adding to the company's operations. And we'll look into that in more detail in the coming weeks. Thank you, and have a wonderful learning experience with this Module 6. Bye for now, and see you in the classroom. Bye.